Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts and investment advisor Vivek Mavani and Vineeta Sharma of Narnolia Financial Advisors join me on the show. Thank you to both of my guests for joining me. Today on Hot Money, we'll discuss the insurance sectors. Of late, we've seen a lot of bulk deals that are happening there. Avanti Feeds is down almost 60% from the recent highs. What's plaguing the stock? ONGC of late now says the CPAC is over. Will there be traction that's coming in? And with the oil prices now rising, is there traction for ONGC? And we ask our guest which is the mid-cap stocks that they are recommending to their clients at this point of time. But let's start with the first stock. The first one is the insurance sector. Of late, we've seen a lot of bulk deals that are happening. A lot of companies now are listed in the insurance space. Initially, we just had a few. But what's the view overall on the insurance space? Are stocks attractive? And what's the best buy? That's what we're asking our guests. So Vivek, I'll start with you. It's a broad theme, insurance, your general insurance, life insurance. But overall, what's your view on the insurance theme if someone has to invest for the long term? And if they have to invest, which is the stock that they have to look out for?
Okay. As far as insurance is concerned, you rightly said that in the last 2 years, several insurance companies have got listed both in the life insurance space as well as general insurance space. And all of them are like all leaders in the sense HDFC, SBI, ICICI, both life and general insurance. I mean, we have had New India Assurance, general insurance also getting all of them getting listed in just span of about last 18 to 24 months. To come back to your question, there have been a lot of bulk and block deals. So basically, there's a huge amount of accumulation happening in the especially in the life insurance space on the basic premise, which is three things that what happened in private banking space in the last 20 years, where new private banks took share from the state-owned or PSU banks. Same is the premise for both life insurance and general insurance, where PSUs, in life insurance we have only Life Insurance Corporation, LIC. In general insurance we have 4 or 5 companies losing share to private insurance companies. The total pie itself will grow at a larger pace given the aggression and greater distribution, the deeper distribution beyond the cities or urban areas. So that is basically the premise of a long-term secular growth. Each of them good quality management. I mean, you can't really fault managements of HDFC or ICICI Prudential backed by the ICICI, of course, Prudential of UK, or even SBI, etc. So you have good quality players growing at high teens to low 20s in terms of premium collection year after year, which itself is on greater financialization of, which rides on greater financialization of savings. The third aspect, growth trigger for the sector itself is greater awareness for risk, A, and B, greater planning for retirement and pension, etc. So that is what is basically driving the life insurance space. Between life insurance and general insurance, life insurance relatively is a more attractive because the stickiness of the customer is long, the growth visibility is for a much longer period, unlike general insurance where there could be periods of high and low growth, but not necessarily in life insurance. Among the 4 life insurance companies that we have to choose from, your earlier chart showed 3. The 4th one is, of course, Max Life Insurance, which is part of Max Group. So indirectly there is an presence. The 5th one being Birla Sun Life Insurance, which is part of Aditya Birla Capital. So you can't take direct exposures, but you take indirect exposures via the other 2. For me, ICICI Prudential Life Insurance is a preferred pick. From the time of its IPO, it's had which was listed at discount, had a rally, and it's come back to more or less the IPO price, which was 330. So, but during that same period, what we have had is the company, ICICI Prudential has delivered growth every quarter since the time of listing. A. B. In its own business profile, which currently or last few years has been heavy on ULIPs, tilting more towards ULIPs, is over a period of time changing character to more of protection or risk products. Just to give a sense, what does that shift of business profile mean? Risk or protection products are more profitable in the both in the shorter and longer term horizon compared to ULIPs. So in terms of margin profile of ICICI Prudential is going to over a period of time expand consistently. So far in the last few years, the profitability of ICICI Prudential has been lower than in HDFC life insurance or SBI, but that profit that's going to catch up. That's the whole thing. On a valuation at about 2 to 2.2 times price to embedded value, which is what seems is the metric for insurance companies to look at. It's a relatively discount to both SBI, a significant discount to HDFC Standard Life. So for me, this is the preferred one.
Okay, ICICI Prudential Life Insurance, something that Vivek likes. What about you, Vineeta? What are you all telling your clients about insurance as a sector? Is it a good investment avenue? And among all the insurance companies, which are the stocks that you're telling your clients to accumulate?
So insurance, certainly we are positive on the sector as a whole, because the kind of catch up we have to make along with the global presence all insurance companies have, there is still a lot of room left for Indian companies to catch up. Secondly, like our recommendation for as regards company is SBI Life Insurance.
Okay.
Two things. One is the excellent branch network and of SBI, which comes along with SBI Life Insurance, and itself it has around 1,13,000 agency networks. So it has a good presence. Secondly, if you look at the overall premium growth, this quarter the premium growth has been around 40%. And not only on the individual as well as group insurance is taking a good traction. Value of new business has grown up by 41%. The renewals have grown up by 40%. So overall, the premium side growth is there. If we consider a matrix of all three, SBI Life, ICICI, or the other one, SBI, ICICI and HDFC. HDFC, I think it's one very good thing, but then it's overvalued as compared to this. And ICICI is lacking on the growth side. So SBI, I feel, is a good combination wherein growth is there, and it's not very highly valued. It is right now trading at 2.2 times FY20 embedded value. So I think SBI Life Insurance should be a pick to invest.
Okay, and among the general insurance, are you all pushing anything among?
See, general insurance, if we look at ICICI Lombard, that is giving good growth and it has good futures. Just a little bit on the valuation side, we're still not comfortable. Maybe, a little lower, some 20% down, maybe some, or let's see how the growth pans out. So either the time correction can be one thing or the price correction.
Okay, Vivek, before you just move on, she made a comment that the growth probably is not coming in for ICICI Prudential. Is that something that you agree to?
Well, I wouldn't say growth is not coming. It's just that growth has been relatively slower than HDFC Standard Life and SBI Life. Of course, that slightly slower growth makes up with lower valuation, which is what I mentioned, that it's at a serious discount to SBI, to HDFC Standard Life and to even SBI. Two more points that I would want to add there, which is likely to improve ICICI Prudential's. One more metric in insurance is the persistency ratio, whether people, new policy holders, whether they continue to pay premiums year after year. In case of ICICI Prudential, their persistency ratio over the last 5 years has been increasing year after year. I would say year after year, say over the last 5 years, over a 13-month, 25-month, 37 months. So basically 1 year, 2 year, 3 year, right up to 5 years. Their persistency has been increasing. As the persistency increases, which means the customers decide to stay back and stick with the insurance provider, long-term margins are much better, because we've also got to see that in case of insurance, there's a large commission paid up upfront in the first year, from which the profits are recovered only in the subsequent years out of that policy. So if the persistency is low, the profitability also will be low, because there isn't enough time to make up profits out of that particular policy holder. And if that's a very large amount, insurance companies would struggle to be profitable.
Okay, so that's the view that's coming in on the insurance play. SBI Life as well as ICICI Prudential Life Insurance are the stocks that have been spoken about. The next stock we want to talk about is Avanti Feeds. Now, this was a shining star probably a few quarters ago, and then suddenly, because of issues as far as raw materials concerned and prices coming down, they actually delivered multi-quarter lows over the past few quarters. So numbers have been deteriorating, but it's down 60% on a 12-month basis. What exactly is impacting Avanti Feeds, and is there potential to accumulate this counter at this point of time? We'll ask our guest. So Vineeta, Avanti Feeds at one time was one of the shining stars, and then again problems started and it's trading at a 52-week low. Is it a good time to accumulate? What went wrong for Avanti Feeds?
So Avanti Feeds, since 2009, government had, at that point of time, government had pushed shrimp cultivation in the country, good way. And at that particular time only, we had seen some Southeast Asian countries, they were witnessing some shrimp disease, and it went because it's a small aquaculture, so it was unnoticed earlier, and then it went on increasing till 2014. It went off and extended up to Malaysia and stuff. So that was the reason when Avanti Feed caught the right structure, right market, and the management very prudent way of having the balance sheet, etc. So at this point of time, these Southeast Asian countries are coming back. So there has been a good amount of stockpilation as regards, which has brought the shrimp prices down, as well as some near-term risk, like US had an extended winter, and that led to prices of shrimps going down because of stockpilation. As regards the raw material, both the fish meal and the soy meal, which are the main components of some 40-45% component of the feed, they went up, and in the last quarter only they went up by 24%. So overall there has been a good amount of margin deterioration in the company, because shrimp prices falling down as well as the raw material cost going up. At the same time, the volume of the company getting little bit eroded, and management has also guided for the next quarter or for FY19, they're assuming a flat kind of volume growth, which was some good percentage from 2009 till date. So all of these have impacted. So Avanti Feed has been impacted from multi sides, and that's the reason which has a very that's the reason we see top line, bottom line eroding away, and that has caused the return on equity.
So is
for
it
the
a good
company
time to start accumulating, or do you see more pressure that will come?
See, this kind of this is something which is a cyclical issue. So also US, if you look at it, the anti-dumping duty has been increased. There has been increased rejections from the European countries, because they have very stringent norm as to what quality. So management is very good in the quality aspects of what they are delivering. They have increased their capacity of shrimp processing. So not only the feed, but also the shrimp processing, which is right now 17%, they are expecting it to go up. So at this current time, the overall margin scenario doesn't look to turn again on the brighter side in a very short period. So I could say, because the ROE will dent from 40% to 17-18%. So it will call for a valuation degrowth for the company. So maybe we can keep 2-3 trackables, because these trackables are very easy to find, like shrimp prices or the volume growth. If the management commentary you keep on hearing, if they expect something good out of it, then it's a time to get into it.
Okay, well, that's the view that's coming in. Vivek, Avanti Feeds?
Well, to come straight to the conclusion, I would just avoid a company like Avanti Feeds. I would actually avoid the entire sector. between 2013 and 2017, I mean, the stupendous run that it had on back of multiplying profits, expanding margins, increasing return on capital, return on equity, large number of market participants actually forgot that shrimp business is cyclical. I mean, most people forgot. I think even the management forgot about, and if we were to listen to the management commentary over the last few years or last few quarters, I mean, there seems to have been somewhere a sense of denial on part of even the management that they are in a cyclical business and the cycle can turn for the adverse. As Vineeta mentioned, what propelled the stupendous growth in Avanti Feeds, both in terms of profits and hence the stock price in that 5-year period, was supply constraint in Southeast Asia, Vietnam, Thailand, China because of some disease. And so there was a global shortage which led to shrimp prices shooting up, but that scenario got corrected. I mean, so there is supply coming in from Vietnam, Thailand, China. So now what we have over the last few months is oversupply in the global markets, while even their raw material prices have gone up. So on one side, their selling prices of the end product has fallen and raw material prices have, so which is a squeeze on both sides, which has led to this kind of, I mean, almost 60%, as your screen shows, 60% fall in the last 1 year. Peak to the bottom, probably it's a little more than that. Now, is it likely to reverse? Well, one really doesn't know when the cycle will turn, because for the cycle to turn, what you need is again some sort of a supply constraint at some point of time in some geography, which we don't know when is it going to happen, if at all it will happen, because the demand growth is not going to be like shooting up to create that shortage scenario that we had for a couple of years between 2013 and 17. So I would simply avoid such cyclicals. No, I'm not averse to cyclicals, but these kind of cyclicals were in a very short time period. Either there is an oversupply or there is a shortage, which creates much more I would say violent price moves both on their raw material as well as on their selling price, which actually becomes difficult to monitor. I mean, I will slightly disagree with Vineeta, or it's probably my inability to really understand those factors. So it is best to stay away, because one can't really time that cycle, one can't really accurately get the cycle right, and management guidance or commentary really doesn't help.
Okay, so that's the view that's coming in on Avanti Feeds. Let's move on to the next stock, and that is ONGC. Hasn't participated much. A large cap in the oil and gas space, again, has been seeing a significant amount of weakness of late. Crude obviously plays an important role. It's down almost 20% in the last 12 months. So on all time parameters, ONGC has disappointed. What we're asking is there more potential downside on ONGC, or is it the right time you start accumulating? It's at close to 140 now. Vivek, ONGC, what should one do? Should a long-term investor put their money on ONGC hoping for a bounce, or should they just stay away from the counter?
I think one should just stay away. So, I mean, in fact, I will add to the statement that ONGC has not participated in the rally. Well, if you actually look at a 5-year bull run between 2013 to 2018, ONGC was a laggard even over a 5-year period. So, if it has been a laggard over the last 1 month, nothing really surprising. Two things. I mean, the stock price participation in a rally has to be on back of rising profits. And in case of ONGC, even when oil prices rise, ONGC's profits don't rise by that expectation that I would have wanted, because some joker comes in, some factor that we are unaware of or unexpectedly comes. Either they need to either share higher subsidy burden or something or the other, which in the last few years keeps dampening the sentiment on higher crude prices, and hence ONGC's profits really don't rise. What we have now in 2018 is ONGC buying out HPCL in the government's holding in HPCL. So for the government it's a disinvestment, but for ONGC actually it becomes a burden to carry, because the cash surpluses of ONGC, which otherwise should have gone into new discoveries or ramping up production of their oil and gas, actually goes into buying shares of ONGC and digesting that merger. Now, any amount of justification on part of management of either ONGC or HPCL or even Government of India that there are synergistic benefits. Well, actually, it's difficult to believe that because track record of any kind of M&A activity of this type, especially which involves two government companies. I mean, I could look back Air India and Indian Airlines, even when being in the same business, even after 12, 13, 14 years, I mean, we hear that the two have not really integrated either at the management or staff or in terms of their utilization of assets. In case of ONGC, I mean, there are different businesses in the same value chain, but they really have no synergies because ONGC is at one end on production, and downstream they have the petrochemical business, which is MRPL, and HPCL actually comes in the middle. Conceptually, yes, it's a great synergy, but I don't think if within the value chain there is really synergy benefits which management will be able to extract.
Okay.
Probably if we were to have the same discussion 1 year, 2 year down the line also, ONGC would still have been a laggard. I mean, I can stick my neck out on that.
Okay, Vineeta, what about you? What are you all telling your clients on ONGC?
So ONGC, if we look at the standalone business sales have grown up by 40% and profits have grown up by 60%. The standalone business still remains very attractive. But and also the company has some 80,000 crore capex plan, wherein the production is expected to grow up by 10%. There could be volume growth of 10% from FY20. Currently, there has been good volume growth in the gas segment, and the crude segment witnessed little lower volume because of some rigs which were getting converted into mobile production unit, and that's the reason we saw some delayed production of crude. So if we look at just the standalone business, ONGC looks pretty okay. From the profit and loss account point of view, I don't think ONGC has anything bad. The problem is the capital allocation strategy of the company, or I would say not of the company, because the company at times has been, asked by the government to do certain allocation, which I don't know whether they were internally very okay with it. Like you can, like as Vivek also suggested, the HPCL merger. So all these, if we consider, we are not very hopeful on how the capital allocation going ahead will happen, because anytime some news might just crop in, and that should keep the ONGC valuations little lower. Okay. So at this current valuations, 140, the prices seems to be pretty cheap. So once somebody who wants to have a portfolio bet can have ONGC. We are recommending buy, and we have a price target of around 200 for the company. But for a retail investor who has less tracking of a stock, who are not very, often they are not able to track the stock, I would ask them to stay away.
Okay, so that's the view that's coming in on ONGC, and what we've seen right now is that the rally has happened on the Nifty, but it's basically the few large caps that have managed to move. Mid caps still aren't in the rally mode, but no doubt clients are asking for mid cap stocks. So Vineeta, which mid cap are you recommending your clients at this point of time?
So at this point of time, all the sectors have some or the other nuisances that is going on. And in the mid cap, in fact, we are liking corporate lenders as such, as a space, because we are seeing not only the growth trajectory improving for the companies, but also the valuation. Accordingly, the valuation increase in the book value would result in the increase in re-rating of the price to book multiple also. In the mid cap space, we are liking Federal Bank. And there are several reasons for that. One is the management has been very conscious of how they are allocating. So it has a corporate portfolio of around 46%, and 45% is the retail portfolio. In the corporate portfolio, they have AAA rated funds as around 70%. And BBB is around 17%, and so on. So the corporate loan book on the better rated funds is quite managed. As regards the stress assets are quite much in control. Recently, there was around 400 crore of fresh slippages, out of which most of it was the Kerala impact, which would obviously not come in. Management has clearly guided for around 1400 to 1500 crore of fresh slippages going forward, and from where things should turn. So the loan book advances are growing. The main problem that we are right now facing is the net interest margin. So even in this bad scenario, the net interest margin for the company has been stable. And if the management continues the repricing of the assets, loans at the MCLR, I think the NIM should, if not worse, it should be maintained at this level. So we are seeing a good amount of, because the provisioning requirements look to achieve at its peak right now, and that should bring the re-rating of the Federal Bank.
Okay, the Federal Bank is the one that Vineeta speaking about. Vivek, which stock are you recommending to your clients in the mid-cap space?
Yeah, so I have been liking large number of mid-caps, bottom-up companies that have been delivering growth quarter after quarter, and prices have corrected, and hence valuations tend to have become attractive. So one of the stocks is Swaraj Engines. I've spoken about this on your channel earlier also, but subsequently the stock has corrected almost 30% in the last few months. So it's at about 1450 odd now, which is basically, this is a company that supplies tractor engines to North India business of Mahindra & Mahindra, what used to be erstwhile Punjab Tractors. So this used to be a sister company of Punjab Tractors, jointly owned by Mahindra Group and Kirloskar Group as promoters. Very transparent transfer pricing policy for tractor engines for Mahindra. So this company is pretty much assured on margins, they are assured on receivables, and a very high return on capital and return on equity. A very clean, debt-free balance sheet with surplus cash and cash equivalents of more than 150 crores on a very small equity. This is among the few companies which has a dividend payout of almost 90% of its net profits, and so it's a dividend yield as well. I mean, financial 18 they paid out 50 rupees of dividend, 55 rupees is likely for the current year. So it's almost like 4%, close to 4% dividend yield. They did a buyback at 2,400 earlier this year in 2018 itself, February 2018, they did a buyback at 2,400. So at current price of 1450, it trades at just about 18-19 times current year earnings and about 15 times 1 year forward earnings. The dividend yield gives the margin of safety in terms of downside protection. So I'm positive on Swaraj Engines. I'll also make the disclaimer, I have a personal interest as well as interest of clients invested in Swaraj Engines.
Okay, so that's the view that's coming in. Federal Bank as well as Swaraj Engines were the stocks that were recommended as mid caps that need to be taken into consideration. But with that, it's a wrap on today's Hot Money. Vivek, thank you so much for coming in. Vineeta, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.